Have you looked at the US Treasury market recently? Do you even pay any attention to bonds? In this video, I'm going to explain why, well, the US 10-year Treasury being at 4.36% is significant to your financial well-being. Nobody pays attention to the bond market. No retail investor I've ever spoken to has said, yes, I study the bond market. It is very fascinating. It is the most liquid market in global existence. Nobody says that. Nobody gets on CNBC and talks about the bond market in big terms. Nobody talks about it on YouTube. Yet it is one of the most significant markets in the world. If you want to know what's happening in the world, if you want to prepare for where to invest in the future, you study the bond market. Because it is the largest market, because it is the most liquid market in the world, it can tell you enormous things. March, April of 2019, I am talking with my business partner at the time, Valerie Leonard at EverThrive Financial. Check her out. She's got a great firm. And we were talking about bonds. And at that time, the German Bund, 10-year German Bund, was at a negative, if I remember right around 0.23%, negative. Meaning people were buying this bond and paying essentially to own it. And the reason they were doing it, come to find out later on, was because they knew something was up in Asia. Something was up that was going to disrupt markets and disrupt how we were doing things in the near future. Fast forward to October, November, December of 2019, and what hit the headlines? Oh, this weird illness in China. They're starting to, well, they're a little concerned. Fast forward to March of 2020, and what happened? The pandemic. The bond market told us this was coming. Did it get specific? Did it write you a love letter and say, hey, everybody's about to get sick and they're going to shut the whole world down? No. But the bond market told you that fear was in the air and they were moving into bonds, treasury bonds. And in particular, they were doing this because they were highly collateralized at the time, giving you the ability to exchange that pristine collateral for currency. And when March of 2020 hit, we saw a movement that exchanged those treasuries for US dollars, and we saw the US dollar move higher. That's how it works. If you're a country, say Vietnam, China, or Indonesia, and you want US dollars, oftentimes you stockpile US treasuries. You then take those treasuries to the Fed window, the Fed funds window, the repo window, and you exchange those out. And maybe you exchange them out for overnight, or maybe you exchange them out for longer periods of time. But you're doing that so you can get something of value in exchange for what you have of value, and that is US Treasuries or German Bunds or UK Gilts. These are bonds, and the world works on this massive borrowing and lending kind of world. This is how we do things. You go to a bank and you borrow money for a mortgage, and your collateral is your home, because if you don't pay, they come take your home. If you get a car, you get a loan. What is your collateral? Your car. Well, on a corporate or country level, in particular countries, they use high-grade US treasuries or pounds, or not pounds, but gilts or bunds to use as collateral to exchange out eventually for currency. Well, in the last 6 months, the 10-year Treasury has sold off to its lowest level or highest level on the yield. Value on the bond goes the opposite way. So it's like you and your buddy are on a playground on a teeter-totter, and your yield and he's the value of the bond. And when you go up, he goes down, and the value of the bond goes down, and vice versa. Well, for the last 6 months, we have been seeing this major sell-off in US Treasuries. And today, we broke to 4.13%. The last time that happened was in 2008. 2008. If you remember back in 2008, what was going on? People were becoming homeless. People were losing their homes. Banks were failing. You saw Lehman Brothers go bye-bye, and then you saw AIG just almost go out of business. And what we're seeing today is a similar event. A similar event where people are selling their treasuries and they're buying US dollars. So why is this so important? Well, one, it is the most liquid market in the world. Two, it is the basically barometer of how well the economy is doing. And three, if you're not paying attention to the bond market, in particular the Treasury market or Bund or Gilt market, you're dreaming at this point. If you think this equity market is going to continue to go higher, and you've got people selling off bonds and buying US dollars, you're crazy. We're nowhere near a bottom yet. Actually, it is projected that this downturn is bigger than the financial crisis. And if you lived through that and you had friends who lost their homes, I mean, I had a friend who he bought a new Porsche every 3 years. He was on a first name basis with Porsche USA. And then I saw a truck pull up in front of his house, and because he collateralized his home through his business, he lost his home because his business dried up, because his bank dried up, because he got called out on a loan, and he was told to pay it back, not in 3 years, but in like 3 weeks. And it was a big loan, and it ended up taking his house. It happened to a handful of people I know. And what I see happening now is you're getting a call on borrowed money. The Gilt, 10-year UK Gilt, sold off massively because of a margin call. A margin call on UK pensions. Roughly 145 of them got a margin call. And it wasn't, hey, fill this margin call, put a little more money in your brokerage account and say, well, you know, in the next 2 or 3 weeks. It was hours they were asking for that money. And so what do? The pension funds go in and they sell their liquid asset, and that was the Gilt. And they sold it, and the yields jumped, and it caused panic, and it caused the German or the UK pound, British pound, to plummet. We're in a situation, number one is the beginning of this situation. Two, we're in a situation that is bigger than the financial crisis. And the bond market is telling you to beware. With the 10-year US Treasury going to 4.13% today, you best be in cash. Because right now, cash keeps going up. US dollars keeps increasing. You go back a year ago, and you will see the US dollar has been moving higher, higher, and higher. And I believe you're going to see an explosion higher. Now, also remember, with the US dollar rising, it is causing enormous havoc throughout the globe. Why? Because if you buy if you're in Europe or you're in Asia and you're buying, say, US goods or services, and you have to exchange out your currency for US dollars, you're paying a whole lot more. That's inflation. You are paying an enormous amount because of that exchange rate is so wide. The US dollar is here, your currency's here. And when you have to exchange it out, you have to exchange say 1.13 more times or 1.4 more times or whatever it is. Look at the Japanese yen. It's getting slaughtered by the US dollar in that relationship. So you're having the US dollar rise is actually a bad gig. It's a bad thing for us on a global scale. And so you need to be thinking in your head, hey, if this thing is really starting to slow down and we get into fourth quarter earnings, say first quarter of next year, and they are really bad and the banks actually miss because they don't have enough trading volume and trading fees like Goldman Sachs and Morgan Stanley and JP Morgan have made, then you've got a problem. The other part of it is you're going to see more defaults on a credit card level, a car loan level, and I believe on a housing level. Housing is at a 20-year demand for new mortgages today or yesterday. Today came out, and this is the 18th of, it's the 19th of October. Holy cow, the year's going by fast. You're seeing housing applications for to buy a new home have plummeted. They were down like 4.5% week over week. They're down 38% year over year. We are at a, believe, 25-year low on mortgage applications. Things are rapidly changing, yet the talking heads of CNBC and Fox and CNN, oh, it's all good. Joe says it's all good. It ain't all good, folks. So you need to get defensive. And the way you can get defensive and preserve capital is go to cash, is go to a portion of your portfolio in cash, because you will get a great opportunity to buy into this market and to buy good companies who have solid fundamentals, who are making money and changing the world. But today isn't the day. And losing money, well, that ain't cool. That ain't cool. And I don't care what anybody tells you, what financial advisor tells you. We just stick it out and we'll ride this out. Well, if this thing drags out for 24 months, you don't reset. Age-wise, you get older. And if you have to take 3 to 4 to 5 years to recover, to get just back to where you were at the beginning of the year, you're going to be set back financially. You're going to be sitting in a situation of, well, I can't retire at 65. Instead, now I have to retire at 72. When you lose money, you have to make bigger returns just to get back to zero. And if you're down 20, 30%, how much more can you stomach? And if you think you can stomach more, how much longer do you think you could live? To make that up, say your average person lives to say 87. If you lose 5 years worth of growth and you have to make that back up over the next 3 to 4 years, 5 years, well, let's say you now need to enjoy retirement as you had expected. You need to live another, say, 5 to 10 years to do so. I know that makes really not a whole lot of sense, but I think you get my point. Losing money is not cool. And the bond market is telling you, hey, knock, knock, I'm about to put some pain on you. So start getting defensive. Start taking the right action. Start protecting your family.